Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. Now, I've drawn in a major trend channel and some outlying trend channels. You can see the big thing I want to show you here is this trend channel reversal. You can see the move from about 1890 all the way up to about 1990. So about a $1 move. But what's significant about this move is that it was a one-day reversal in the trend channel, and out of it a breakout of that trend channel. The higher trend channel, you can see, has not been penetrated. Today it was tested. We're falling back to the upper line of this other trend channel. So we may be looking at the reversal of this downtrend. Now, you know that this downtrend has gone on for a very long time. It's gone on for over a year now. We actually need to pull back all the way to the daily to see how long this current downtrend has gone. And the major downtrend has actually gone on all the way back since that 2011 top. So currently the breakout price is going to be quite a bit above the other trend channel I showed you. We're looking at $23 to break out of this very long-term mini bear market is what I'll call it. Now, the story that I'm covering tonight, as you know, I tend not to be a person who hypes things. I don't believe in hyping things. But I honestly believe that the story that I'm going to cover tonight is one of the most important stories that I've ever covered. And I want to start off with the interview with Grant Williams. If you haven't heard this interview, you need to listen to it because, and this is on King World News, Grant Williams on December 4th revealed that there is now an investigation into the London gold fix. So let's look at that story. And this is from Bloomberg. It's from November 26th. And we'll read this. Every business day in London, 5 banks meet to set the price of gold in a ritual that dates back to 1919. Now, dealers and economists say knowledge gleaned on those calls could give some traders an unfair advantage when buying and selling the precious metal. You think? The UK Financial Conduct Authority is scrutinizing how prices are set in the $20 trillion gold market, according to a person with knowledge of the review who asked not to be identified because the matter isn't public. The London fix, the benchmark rate used by mining companies, jewelers, and central banks to buy, sell, and value the metal, is published twice daily after a telephone call involving Barclays, Deutsche Bank, Bank of Nova Scotia, HSBC, and Societe Generale. The process during which gold is bought and sold can take from a few minutes to more than an hour. The participants also can trade the metal and its derivatives on the spot market and exchanges during the calls. Just after the fixing begins, trading erupts in gold derivatives, according to research published in September. 4 traders interviewed by Bloomberg News said that because dealers and their clients are using information from the talks to bet on the outcome. Quote, traders involved in this price determining process have knowledge which, even for a short time, is superior to other people's knowledge, end quote, said Thorsten Poliet, chief economist at Frankfurt-based precious metals dealer broker Degussa Gold Handle GmbH, and a former economist at Barclays. Quote, that is the great flaw of the London gold fixing. The UK capital is the biggest center for gold trading in the world, according to the LBMA, which said more than $33 billion change hands there each day in 2012, exceeding the $29 billion of futures traded on the COMEX, the New York Commodities Exchange, data compiled by Bloomberg show. Financial instruments, including cash-settled swaps and options, are priced off of the London Fix, according to the LBMA website. In private meetings this year, the U.S. Commodity Futures Trading Commission, which regulates derivatives, discussed reviewing how gold prices are set, according to a person with knowledge of the talks. The FCA review is preliminary and not a formal investigation, another person said. The people wouldn't say what's being looked at or if regulators suspect wrongdoing. Participants on the London Gold Call can tell whether the price of gold is rising or falling within a minute or so, based on whether there are a large number of net buyers or sellers after the first round, according to gold traders, academics, and investors interviewed by Bloomberg News. It's this feature that could allow dealers and others in receipt of the information to bet on the direction of the market with a high degree of certainty minutes before the fix is made public, they said. Now, it goes way into this issue, and the reason why I think this is so important is because the idea that came to my mind after listening to Grant Williams on King World News is, what about silver? Is silver fixed as well? And the answer is yes, silver is fixed. Now you need to think about that while I'm going through this, because silver is not a tier 1 asset according to the BIS. It's not even considered money. So let's start off with the LBMA. Now, you can go to a site that's called silverfixing.com, and that is one that is actually cited at the LBMA. You can see this note here. If you wish to use the gold or silver fixing prices for commercial purposes, including to incorporate them into commercial products which you intend to market, sell, or otherwise provide to third parties, you must pay the required fee and obtain a license from the London Gold Market Fixing Limited or the London Silver Market Fixing Limited as appropriate. And there's the websites. Now, this is the website of silverfixing.com. That is the website that is linked there from the LBMA. I'm leaving it at the terms and conditions page, because if you read these terms and conditions, you'll find out that it's a copyright violation to go into these. So I'm not going to go to the page because I don't want to be sued, but I have found a page that comes from another site that quotes some of the information about this silver fixing. This is the history of silver fixing, and this is quoted on indiabullion.com. The London silver market has developed over the last 300 years. The first recorded deal was entered into by a market member in 1676 when Makata, that's going to be a big name because Scotia Makata is one of the big boys in rigging silver, when Makata started trading with the East India Company. The price at that time was 63 pennies per troy ounce of standard silver. Towards the end of the 18th century, the next member entered the arena, originally known as Sharps and Pickup. They shortly became Sharps and Wilkins. During most of the 18th century and for the first part of the 19th century, much of the business transacted in the silver market took place in one of the original London coffee shops. Although the firms concerned had individual offices, much of the gathering of information took place in coffee shops, making them a natural venue which to transact business. In 1852, saw the entry of Pixley and Haggard, who 5 years later became Pixley and Abel. This was followed 1 year later in 1853 by the founding of Samuel Montague and Company. The price of silver in 1853 was 61.5 pennies per ounce of standard silver. The daily silver fixing commenced in 1897, although it is believed that a system of agreeing to a daily spot price had evolved by the use of runners between the four houses of a few years earlier. The first fixing was attended by all four members, Makata and Goldsmith, Sharps and Wilkins, Pixley and Abel, and Samuel Montague and Company. Within a very short time, two prices were fixed daily: cash up to 7 days and 2 months forward. The cash price of silver in 1897 was 27 9/16 pennies. The silver fixing has continued until the present day. Starting in 1967, the format of the silver fixing was amended, whereby the price was fixed for spot 3, 6, and 12 months forward, and at the same time the US dollar equivalent was officially published. In 1999, the fixing further evolved into a telephone-based process with spot prices for US dollar, sterling, and euros. The silver fixing continues unchanged to this date and has proved to be the most acceptable pricing mechanism for producers, consumers, arbitrageurs, and speculators. So that is a shocking revelation. They're still fixing the price of silver. Now, if we go to the LBMA's website, you can see here that the silver fixing information is quoted from 1968. Now, that date coincides with the date that the United States was actually 1 year before the date when the United States completely removed silver from the coinage. If you remember, in 1964, that was the last year that you had 90% silver coins. From the years 1965 through 1969, you had some 40% silver coins, and then in 1970, the coins were 100% clad or zinc. So let's go to the FAQ here. This is from lbma.org.uk, and this is a FAQ about the London gold and silver fixing. What is the guiding principle behind the London gold and silver fixings? The fixings are an open process at which market participants can transact business on the basis of a single quoted price. Orders can be changed throughout the proceedings as the price is moved higher and lower until such time as buyers and sellers' orders are satisfied and the price is said to be fixed. Orders executed at the fixings are conducted as principal-to-principal transactions between the client and the dealer through whom the order is placed. How are fixings used in the market? The fixings are the internationally published benchmarks for precious metals. They are fully transparent and are therefore used to deal in large amounts or to achieve the accepted average price of the metal. As a benchmark, many other financial instruments are priced off the fixing, including cash-settled swaps and options. The silver fixing started in 1897 and the gold fixing started in 1919. Which banks are the members of the London gold fixing? The gold fixing is conducted twice a day by telephone. Can you believe that? Think about that, people. We are living in a day when we have markets trading 24/7, and we have these manipulators and criminals in London who are setting the price of gold and silver by telephone. At approximately 10:30 a.m. and 3 p.m., there are 5 gold fixing members, all of whom are market-making members of the LBMA. These are the criminals. These are the people who need to go down. They are the Bank of Nova Scotia, Scotia Makata, Barclays Bank, Deutsche Bank, HSBC Bank, and Societe Generale. The chairman of the gold fixing rotates annually amongst its members. Which banks are the members of the London Silver Fixing? 3 market-making members of the LBMA conduct silver fixing meeting under the chairmanship of the Bank of Nova Scotia, Scotia Makata, by telephone at 12 noon each working day. The other 2 members of the silver fixing are Deutsche Bank and HSBC Bank. Here's your criminals: Scotia Makata, Deutsche Bank, and HSBC. What is the procedure for arriving at the fixing price? The gold fixing, 5 LBMA members, Barclays, and we've read those, conduct the gold fixing by telephone twice each London business day at 10:30 a.m. and 3 p.m. Orders are placed by clients in dealing rooms of members of the fixing who net all orders before communicating that net interest to their representatives at the fixing. So let's look at the silver fixing. The silver fixing, 3 LBMA members, Bank of Nova Scotia, Scotia Makata, Deutsche Bank, and HSBC conduct the silver fixing meeting by telephone at 12 noon each London business working day. The process then follows a similar pattern to gold, arriving at a fixing price when buying and selling orders are matched. For more information on the silver fixing, please refer to the website of the London Silver Fixing Company. And there it is, silverfixing.com, and that's the company that makes you sign an agreement that you won't disclose anything on their site or you could be prosecuted. So there's the story, people. Silver is fixed every day. Now, I want you to think about how important that is. Silver, by their own admission, is not money. Gold is money. It's a tier 1 asset. The BIS is moving it into that category. We know from Jason Hommel that the BIS has listed in the past as much as 2 to 3 billion ounces of other precious metals. We know that silver, but they're not saying that. They've later modified those figures so we can't trust them. But we know that they're fixing the price of silver. Now, this is the question you need to ask yourself. If everything they're saying is true, that silver isn't money, that silver is an industrial commodity, that silver is common and it's cheap and it's easy to mine, why do they have a London silver fix, and why did that silver fix start in 1968 and continues to this day? And I'm going to tell you the answer. The answer is that the price of silver is rigged, and they are more afraid of silver breaking out by far than they're afraid of gold. Silver's only set one time. It's set in London, and I've named the players. These are the criminals who are rigging the silver market. These are the criminals who are soon to go down. We know from this story breaking that the London gold fix is going to be broken up. It's not a free market. It's not a real market. It's a rigged market. It's worse than LIBOR. And the silver rigging is actually worse than the gold rigging. And they have absolutely no explanation for why they are fixing the price of silver. And we'll talk to you next time.